Hello, welcome back to the show. So in today's video, I'll be talking about 52-week low stocks that are worth a look at right now. So in today's video, I'll be covering a few things. We'll be covering 52-week low stocks, my thoughts on Uber stock, Inaction, as well as some questions that you guys have left me in the comment section below. So the first stock that I'll be talking about today is none other than General Mills. So this company over here, if you don't know what they do, they basically sell all your different food products. So this company over here is currently trading at an 11 times earnings, and this year is down around 17% year to date. So for General Mills over here, here are some of the products that they sell. They sell your Nature Valley products, they sell your Pillsbury products, they sell Haagen-Dazs as well as Cheetos. So these are more of their notable brands as well as Annie's. So for General Mills over here, this is their earnings that they had just recently. So the net sales were down 5% year on year itself, and then the gross margin was up 40%. Operating margin was down around 2% or so, and earnings was down around 7% or so. And that's why the stock has been falling since the start of this year. It's because of the bad earnings itself and because of tariffs as well as foreign currency exchange problems. So for General Mills over here, if you have to look into the earnings report itself, the net sales is actually dropping year on year itself. So revenue is dropping, revenue is around stable and dropping, and the net earnings is actually only up around 3% or so. So this is what you normally see with all your consumer staples. They are normally very slow growing, and the only way for you to get returns out of them is through dividends as well as buybacks. So for General Mills over here, the volumes are actually declining as well. So this is normally a bad sign when it comes to owning a company like this. When your volumes start declining, and if they don't have the pricing power to basically increase their prices, then you will see their revenues dropping over time, which is normally what you don't want. So for General Mills over here, this is their free cash flow. So if you were to look into the numbers itself, the operating cash flow is around $2,306 million. And if you were to net out their capex over here, which is around $405 million, that will give you around $1,900 million over here. And if you were to compare it to what they did in terms of their buybacks as well as dividends, they're basically giving back 100% of the free cash flow to shareholders over here in the form of dividends as well as buybacks. So currently now, the stock is trading at around an 8.5% free cash flow yield. And if they were to hold that multiple at an 11 times earning, that's already an 8.5% return back to its shareholder before the withholding tax. If you're to include the withholding tax as well, that will be around a 7.5% returns over here. So I think it's quite attractive at this price without any form of multiple expansion. But of course, you can see a reversion to the mean. And with the multiple expansion behind this stock over here, you could easily see a 10 to 11% return on this stock over here, or even slightly more. It's a deep value one. It is not one that satisfies all my high quality metrics that I have, but it could be a short-term play that could work out as well. So I'll be looking into this one. Next set of stocks will be a healthcare insurance stocks, United Health as well as Elevance over here. So they've been hit very hard recently as well, and they're down because of multiple reasons over here. So you have your regulation. So the Trump administration is not particularly friendly with all your different insurance companies over here. And then you have bad earnings as well. So Elevance last year, they lowered their guidance by more than 15% or so, and that's why the stock dropped around 20% after its earnings itself. Same thing for United Health this year as well. They lowered their guidance, and then now they're removing their guidance as well. So there's an element of bad earnings as well. And then you have all the different fines that could come from fraudulent behavior over here from United Health as well as Elevance over here. So United Health is currently facing Medicare Advantage fraud claims. So people are basically speculating that United Health could be committing fraud. And if that fraud materializes, then United Health will not only lose their Medicare portion of the business, they will also have to pay around a $15 to $20 billion worth of fine over that. So this could hurt the earnings of the company, and overall, they've been beaten down this year. So for example, over here, Elevance Health is currently facing some sort of lawsuit. So they've been seeing lawsuits and lawsuits almost every other day or so. And even today itself, Elevance is facing another class action lawsuit over here, a fraud alert lawsuit. So you're seeing all these healthcare insurance companies basically being hit by a lot of bad news over here. So for insurance industry, insurance is typically a bad business to invest in because there's low margin, there's regulatory risk, and it is an unknown business model as well. So you don't really know how they make their money. So for example, for United Health over here, they have a lot of different business model over here, and it's impossible for you to basically understand everything in detail unless you're working there. They have the Optum RX, Optum Insights, Optum Health, and then they have the United Healthcare Insurance portion as well. All these different portions make up the entire earnings of United Health, which is extremely complicated over here. But for United Health and Elevance over here, they're looking quite cheap and compelling stocks right now. So Elevance Health is currently trading at a 12 times earnings. United Health is currently trading at a 12 times earnings as well. So for me, I think United Health is a more high quality business, and I think in the healthcare insurance space, United Health is a better bet right now as compared to Elevance Health. I mean, if you're to look at United Health's PE ratio over the past few years or so, this is the mean. The mean should be somewhere here, which is around a 22 to 24 times earnings. So currently now it's trading at half the mean valuation over the past 5 years. and that's why it's a compelling buy right now for me. But of course, this is sort of like a high risk, high reward scenario over here. If the fraud materializes, then you could see this stock halving in price, but I see that as highly unlikely. Next stock that is near its 52-week low is one that is not really talked about, but it is one that is very popular amongst dividend investors. It is Realty Income Corporation, which is your REIT in the US itself. So for Realty Income Corporation as well as all your different REITs are down because of high interest rates. So when your interest rates are high, what happens is your borrowing costs will increase over time, and this will drive down the margins for all your different REITs who need to borrow to go and buy all the different properties. So for REITs, what they do is they need to go and borrow money. They need to basically get on leverage so that they can buy properties, and then they'll collect the rental yield as income. So when the borrowing costs are high, not only will they have to pay higher interest payments, they will also not be able to borrow money to basically buy new properties over here, which is why all your different REITs are coming down this year, and even the Singapore sector REITs are down as well. So for Realty Income Corporation over here, the dividend is quite high. So the dividend now is around a 5.8%, and compared to all its US counterparts, this is actually one of the higher dividend rates already. But the problem with owning US stocks and high dividend stocks in the US itself is your 30% withholding tax. So if you didn't know, all your different American stocks, you have to pay a 30% withholding tax for the dividend itself. And so if you're to shave off 30% from Realty Income Corp over here, that is around a 4.5% dividend yield for Realty Income Corp. So for me, I think buying Singapore REITs instead will be a better option. The REITs in Singapore, they yield around a 5 to 6% dividend yield anyways, and there is no currency risk, and your dividends will hold stable throughout the years. Of course, your Singapore REITs, they won't increase their dividend yield, but the Singapore REITs right now, they're currently trading at quite a reasonable valuation. So for me, I don't really like REITs, but I still hold them today because most of them are generally undervalued. They're currently now trading at 1 times or maybe even lesser than 1 times price to book value. But the problem with the business itself is it is highly commoditized. So there's no way for you to differentiate one REIT from another, and it is subject to interest rate environment as well, which is risky. So I'll probably sell them out when they go to around fair value or so. So I hold quite a substantial amount of Singapore REITs, and once they reach around fair value or so, then that'll be where I'll be selling out of all the REITs in Singapore. Next portion over here, I'll be talking about Uber stock. So this is what Mark Mahaney said about Uber stock a while back as well.
Tech has been the second best performing sector in the S&P this year, behind communication services, which also includes a lot of tech companies, too, depending on how you define them. Our next guest says he remains constructive on internet stocks heading into 2025. Joining us now with his top picks for the year is Evercore ISI head of internet research, Mark Mahaney. Mark, thank you for joining us on this holiday week. Let's get right to it. How do you see 2025 shaping up in your sector? What are some of your top picks?
Probably the same way that 2024 is ending. It looks like demand trends remain reasonably robust, whether that's online retail, advertising, travel, cloud, mobility, delivery. There's a series of verticals within the internet, but the growth rates seem to be, frankly, a little stronger at the end of 24 than they were at the beginning into 24. There's more certainty, and I think that'll hold next year. We'll also probably continue to have very high margins. We had a slew of record high operating margins in the September quarter. I think those are largely sustainable. And then you've got this, what I call the gift that keeps on giving, which are these AI deployments, which are just improving processes, creating new revenue streams, allowing companies to grow with much less headcount growth than they needed in the past. So for investors, there's a lot of goodness in the sector. A good chunk of that is priced in. There's very little dislocation in this space. Our number one pick, really the only large cap stock that I think is dislocated, is Uber. Number 2 pick is Amazon. Number 3 pick is DoorDash.
That was exactly my next question, which was this idea of where you see specific catalysts for these and whether you believe that the market isn't fully appreciating that thesis and if there is a gap or a potential for investors to get in now.
Well, so here's my pitch on Uber. It's very dislocated. The stock's underperformed on the year. It's roughly flattish on the year in a S&P 500 sector that's up 20%. And large cap internet's up 40%. So you really got an underperformance here. But it's really triggered by this sell-off recently from, call it the mid-90s down to 60 on the thesis that Uber is going to be robo-taxi roadkill. And it may well be. I mean, that's a possible outcome here. I just think that I'm taking the other side on this. The stock's had a 30% plus correction. That makes it dislocated in my book. And I think it's still a very high quality asset. The world leader, global leader in terms of market share in both delivery and mobility, with an ads business that's building up. You know, it's part of the lucky lexicon, like Uber. Everybody sort of globally knows what the brand means and what it does. It allows them to spend less and less on marketing over time. So the real debate is on robotaxis, but I think it's the largest demand aggregator out there. I think chances are we're going to see robotaxis as part of your Uber app in the future, both on the definitely on the mobility side, maybe on the delivery side too. So I can't guarantee that, but I know that the market is so negative on that thesis that I think it creates the opportunity asymmetric upside. So that's why we're long Uber.
So for Uber over here, if you're to look into the 10K itself, this is what I gathered. So if you're to look into their net income, so this is their net income in 2024. They reported around a $9,856 million of net income. And a big chunk of it was from this tax benefit. It was around $5.7 billion over here. And then they had around a $1.8 billion from other income, which is their realized gain on all the different investments. And it is not the actual operating income. So if you're to look at the operating income itself, it's around a $2.7 billion. And with Uber's market cap right now, it is currently trading at around a 40 to 45 times earnings. So for Uber, it's the same thing for their cash flow statement. So they have around $7,137 million from operating cash flow. But if you were to look into the metrics itself, around $2,819 million was actually from insurance. So what they do is they collect insurance from all the different consumers as well as the Uber drivers. And that portion makes up a very substantial portion of their cash flow over here. It is not actual money that they can keep. It is money that they have to return. And that's why it shouldn't really be included in your real free cash flow calculation. And if you're to remove the stock-based compensation as well, which is around $1.7 billion, Uber's actual price to free cash flow should be around 40 to 45 times as well. So for Uber, in order for them to win long term, Uber needs to make sure that Google, Tesla are not bigger than Uber in the ride-hailing market. So you have Waymo coming up, and then you have Tesla with robotaxis as well. Uber needs to make sure that those two companies, they don't become bigger than Uber, because once they become bigger than Uber, they have a larger distribution network. They'll basically be able to bypass Uber. So Uber needs to make sure that there is no clear winner so that they can continue acting as the distributor. What Uber wants to do is similar to what Google does with search. They want to be the middleman to connect all the different drivers from the consumers itself. That's what they want to do. And Uber needs a slower AV development to basically fragment it, the industry over here. So the best way for Uber to win is for the industry itself to not grow as fast as it should be, and for everyone to basically have their own small sector over here. So for Uber to win long term over here, you're actually demanding a lot. So for Uber's valuation as well, Uber's valuation is not exactly cheap. Looks cheap on the surface, but when you dig deeper, it's around a 40 to 45 times earnings. So the company is aiming for 20% EBITDA growth, but for me, it's the lack of predictability that is basically deterring me from buying into Uber unless the valuation becomes compelling. But the company right now is facing disruption risk, and people often underestimate the risk of disruption. And so for Uber, I don't think I'll be adding into this one. This company is not an extremely high quality business, and for my investment philosophy, I prefer to have high quality companies that are already established as compared to companies that are facing upcoming competition. Next portion over here, I'll be talking about how Inaction will lead to alpha in the markets. So this is Dev Kantasara's portfolio over here. He's the Valley Forge Capital Management allocator, and if you're to look at the action that they had over the past quarter as well, they didn't do anything. They basically reduced their FICO share by around 2%, and they reduced their Intuit stake by around 26%. So for you to achieve alpha in markets, you should be holding stocks long term, holding high quality stocks long term. The most common stock market participant typically holds a stock for a maximum of around 10 months. But if you pick the right stocks like Dev Kantasara over here and you hold them for very long term, you will definitely get alpha above the markets, which is what Dev Kantasara has achieved over the past few years or so. So this is what I'm aiming to do in my portfolio as well. I want minimal action and only add to positions whenever they're compelling. Currently now, the two closest buys that I have are United Health as well as Alibaba. I bought into United Health already. I'm just thinking of adding. Last portion over here, I'll be talking about some questions that you guys have left me in the comment section below. So the first one over here, it says, thoughts on Reddit stock. So for Reddit, I think it's a company that is growing rapidly, but the problem with the business is a few things. Number one, it doesn't have a history of increasing earnings and so on, because the company just IPO'd, I think, last year. And for Reddit, it has around 10% of its revenues actually coming from Google. So if you didn't know, Reddit and Google, they basically signed a deal. So what Google promised Reddit was they will rank Reddit searches higher, and then in return, Reddit will basically give data to Google to train all the different machines as well. So for Reddit, if you were to remove that 10% earnings that they get from Google, which is basically just 100% profit margin business, then Reddit is actually unprofitable. So for Reddit, I think it's a company that is growing rapidly. But in the social media space, I think the best companies to own are Meta as well as Google. Those two companies are typically the ones that you want to hold in this social media space over here. Reddit is a high growing one, but it's a bit too speculative for me. Next question over here, why not Nvidia, especially during the dip this year? So for Nvidia, they're highly concentrated in your AI data center. They have almost around 90% of so coming from data centers. And the moat that they have right now is their CUDA software library as well as the ecosystem that they have. But there are two arguments that I can make for Nvidia over here. Number one, your TPUs are becoming more advanced. So for Nvidia, they have a large proportion of their revenues coming from all the different Mac 7 companies. And if the Mac 7 companies can develop their own TPUs, they will reduce the reliances on Nvidia chips itself. Of course, now Nvidia chips are more powerful than their actual TPUs, and the TPUs are more specialized. But the argument to be made over here is that your TPUs will be able to remove the need for Nvidia chips, which is one headwind for Nvidia. And then you have your export controls as well. And then the last one is simply just its competitive advantage. No one knows how extensive their competitive advantage is. Clearly, they have a strong competitive advantage. That's why people are buying Nvidia chips. But how long that thing can sustain itself, no one knows. And Nvidia has no touch point with the consumers. So if you have to look at all the different other Mac 7 stocks, all your Mac 7 stocks, they're able to scale because they're able to sell their products to consumers. But for Nvidia, it's sort of like a B2B business. But over time, B2B businesses, they are unable to sustain extremely high market cap, basically $2-3 trillion market cap, because it's hard to do B2B as compared to B2C. The scale is a lot harder. So for Nvidia, few reasons. I don't understand the business enough. I think there are better alternatives in the AI space, and that's why I haven't bought Nvidia. I'm holding ASML in this AI bet. Last comment over here, it says, Alibaba's story is sad, it's not coming up anytime soon. I don't really agree with this. Alibaba is a stock that is in a turnaround right now. So if you have to look at Alibaba's earnings itself, the cloud growth, it was around 18% or so. I'm actually quite close to adding Alibaba. Once it reaches my price, I might initiate an entry into Alibaba. So for Alibaba, if you're buying into this stock, you're betting on the turnaround play. And if you have to look at the consumer data in China, the consumer confidence now is at its 10-year low. And if you have to just extrapolate it, basically for it to revert back to the mean, Alibaba will experience a surge in terms of their earnings in retail portions over here. So for Alibaba, they have a few segments in their business. They have their retail segment, they have the cloud. Those two are the money generating machines. Retail around 90% of their total net income. Cloud around 10% of their net income. And then they have their other portions as well, which is your logistic business. That portion is still losing money. And then they have their entertainment segment as well, which is not really profitable. And then you have your international retail, which is around 2% of their total net income. So for Alibaba, you're basically betting on the retail side of the business that is growing, and for the consumers in China to recover. And then for the cloud segment, Alibaba is re-accelerating in growth. So for Alibaba, it's quite a compelling story. This company is still trading at around a 16 times earnings. And for me, I feel comfortable adding Baba at around a 14 to 13 times earnings. That will be where I'll be initiating my position. Around $100 to $110, that will be where I'll be comfortable adding it. Because assuming a 17 times earnings for this stock and assuming a 10% EPS growth, I'll be able to get around a 14% to 15% CAGR if I purchase it at around $100 a share. So I'm just waiting for Alibaba right now. It's a company that is turning around. Its moat in China is almost impenetrable because Taobao and Tmall, they're basically irreplaceable at this point. So I'm just waiting on Alibaba. My bet is that they will turn around soon, but let's see where this one goes. The China government are turning already and they're supporting all the different tech companies against US. They don't want to be bullied by US. So let's see how this one plays out for Alibaba. I hope you guys have found this one useful and invest safe.